Master your money, free your future. Welcome to Budget for Life. My name's Jeremy. I'm a financial advisor. I'm not a professional YouTuber. And this video is not financial advice. In this video, I want to talk about GameStop's fair value. One more angle to look at this conversation is the historical angle, because bears will tell you that GameStop, since Ryan Cohen bought in, has been inflated, right? It's been artificially high, it's been overvalued as a stock. And bulls would tell you it's actually been suppressed, and that even though fundamentally the GameStop story has taken years to catch up, that on a technical basis, shorts have not closed and the squeeze should have continued to squeeze. I would also tell you that since 2017, at least, the leadership of GameStop has been intentionally, pre-Cohen, the leadership was intentionally trying to destroy the company, bankrupt the company from within. I made a recent video about that. So a bull would tell you that 17 and on, really not a fair value for the company. And a bear would tell you, hey, 2021 and on, not really a fair value for the company. So if we want to look at how has Wall Street actually historically valued GameStop, really you want to look at basically 2005 to 2015. Like this is the prime GameStop years, right? This is how this company was viewed, and we can look at their financials, okay? Because GameStop just finished Q2, right? Well, not just, but reported most recently their Q2 numbers. And in a few weeks, we'll have their Q3 numbers. But just looking at Q2, we can look at what does the company do now and versus what did the company do back then? And how is the company valued now compared to how the company was valued back then? And is it undervalued? Or is it overvalued? Is Wall Street looking at this company fairly right now, or is it not? Before I get into it, just want to say thank you to all who have joined the channel as fans and friends, as well as those who subscribe to the channel. We're on a march to 2525, the Halo Sub Club. If you're a part of the Y2K Sub Club, you're also an honorary member of the Halo Sub Club and of every preceding sub club. But we're trying to hit 2525 by earnings so that I can stream earnings, but I probably will stream earnings either way, just so you know. But thank you for the support. I do appreciate it. All the earnings of this channel do go to DRS Booked GME shares. So thanks. Let's get into it, okay? After 2007, okay, after their Q2 numbers came out, GameStop was trading at about $9 billion, upwards of even $10 billion. What were the numbers of the company back then? Right? I've already kind of extrapolated this for you, but you can look, right? They still have all their filings of old on their investor webpage, but their net cash was actually negative $356 million. Okay, so they had some cash in the bank, but they had more in debt than they had cash, right? 120 in long-term notes here, another 574 million in long-term notes there, another 12 million in notes there, versus only 350 million dollars in the bank, right? That was the company then. Let's just keep going. I don't want to take this video, make this take too long, but if you factor in their net cash, that means the GameStop business, the enterprise value after 2007 was 9.3 billion. Now, if you say, well, maybe that was a bubble, that was overheated. Well, it wasn't a bubble. There was a growth story involved. Okay. And the growth was scaling GameStop stores, right? GameStop borrowed this money to open thousands more stores, right, to continue to scale their revenue and thus their earnings. And so because of that growth driver, they were given a premium PE. Their PE back then was actually 187. Or sorry, that's only their operating PE. Their PE was 425 to 1, right? The enterprise value over their net income, $9.3 billion enterprise value versus 22 million in net income, operating earnings of 50, net income. GameStop investors, we're not used to seeing a net income number lower than operating earnings. That's because the GameStop of old had to pay for their debt, right? They had a high interest expense, whereas the GameStop of today has high interest income, right? So the net income number for GameStop investors today much higher than just the operating income. But if you want to look at how to value the company, if you want to put it all together, Back then in 2007, the PE was 425, or if you only want to look at operating, the PE was 187. Now, again, what was the growth story? Scaling GameStop stores. 2014, okay, their market cap after their Q2 earnings was right about a 4.75 billion. There you go, 4.75 billion. Their numbers back then, again, I've already aggregated them for you, but you can look at it yourself. Net cash of negative 21, so a $4.7 billion enterprise value for 37 million of operating earnings, 25 of net income, for a PE of 194 or just an operating PE of 130. What was the growth story then? Well, they had already scaled GameStop stores, but now they were scaling AT&T stores. They were opening their Spring Mobile, right? They're going to get into the mobile business, into the internet business, and they're opening Simply Mac stores, going to get into Apple business and refurbishing for Apple, right? So there's a growth story there and a premium PE based on the growth story. So again, was GameStop overvalued for its entire history? Well, that's a pretty lazy uh, analysis. If that's your takeaway, is well, Wall Street's never looked at this fairly. It's always been a retail-driven, meme-driven stock. Is that true? Were there meme investors in 2007, in 2012, right? We can do the same thing for their 2010 numbers as well, but obviously the '09 market crash, that crisis, has an impact on every business, and um, and at that point in GameStop's business, right, this is the lull between growth stories, right? Oh, 2014 is when they started scaling their tech brands, right? 2006, 2007 is when they were scaling their video games. Then again, they come down because people realize, wait a minute, that growth story doesn't make sense, right? The growth story of video games is not a great growth story because games are going to be sold digitally and GameStop's ability to compete digitally is limited, right? And then the growth story here with tech brands was actually going great. And then GameStop said, you know what we got to do? We got to kill this company, right? Again, you can watch my recent video about that. But look at GameStop today after Q2 numbers that we have, right? Their market cap, net of their cash, which this is their net of their net cash, right? Gives you a 4.1 enterprise value. To me, this is very, very hyper conservative because, again, as you guys know, I value their cash at their actual cash because at no point in their future is there any reasonable scenario where their cash per share will be lower. And that factors in them having to pay back their convertible bonds, right? It also factors in if they diluted, right? Either way, there's no point where their cash per share is lower than it is now. That's why I call this their cash floor. And yes, right now they're actually trading lower than their actual cash floor. But let's say that it's not trading lower than the cash floor. People are just valuing it based on net cash. Okay, fine. 4.1 enterprise value in that case, if you value the cash at 1 to 1, which is not how you would value, right, opportunistic cash. That's how you would value excess cash, which is not the case for GameStop. Again, if you've been watching all my videos, you know this. Still today, operating earnings of 66 million based on Q2's numbers. Q2 operating income, 66.4. So, what's higher, 66 or 37 or 50? Right? Net income, 169 million, or technically 168.6. Tell me, what's higher, 168.6 or 25 or 22? I mean, geez. PE. So for a company with higher operating earnings by almost double what it was in 2014, higher net income by almost 8 times what it was in 2007, and yet their PE is what? A an eighth of what it was in 2014. Their PE is a 20th or whatever, an 18th of what it was in 2007. So GameStop today, with much less bankruptcy risk, right? I'm not saying you have to value the cash on an earnings multiple, but you should value the risk adjusted proposition that is investing in GameStop today. It should matter to you. If you owned a business, you should care whether you have 9 billion in the bank or whether you have negative 350 million in the bank, right? You should care whether you have an interest income of $100 million every quarter or if you have to pay tens of millions of dollars in interest every quarter, right? You don't have to value that on an earnings multiple basis, but yes, that is a premium for a business. That is a reason to add some type of value to the business, the safety, the security of the business itself. It's not dependent on debt. There's no time clock ticking. That's valuable for any investor, right? Earnings. You should value earnings. A company that makes more money should be valued more in general than a company that makes less money. Unless there's impending doom for the company that makes more, and there's obvious growth for the company that makes less. But look at the growth driver, right? What is the more scalable, attractive growth engine? Opening more stores, opening more stores, or scaling online and cost efficient collectible sales, right? A booming industry, far more scalable, profit margins much higher than physical retail locations, right? So you have a premium growth story with a premium balance sheet that's already making multiples more on an operating earnings or a net income basis, and you're telling me that it should be worth a fraction of the way that GameStop has always been valued historically by Wall Street? That's insane, right? And this is based on Q2 numbers. So again, what happens after Q3 when you see the impact of, again, all of that cost efficiency, that transition to more and more online sales, and of course the continued selling of the Switch 2 and the Pokemon Z to A and all the PSA graded cards and the power packs, right? When Q3 numbers come in and this operating income goes from 66 to 142 and this net income number goes from 168 to 220, I mean, holy smokes, 142, 220, right? Again, the operating PE just continues to plummet compared to how GameStop has been valued historically, despite all of these competitive advantages than what GameStop has had historically. So, all that to say, I'm trying to keep it brief. I actually made this video already, and I did it live while I was putting all these numbers over, and it just got a little bit dry. So I threw that video away. I'm remaking another one. If you appreciate it, again, give me a like, give me a comment. I appreciate all the support. But what I want to show you guys is super simply that even if you say that GameStop has been manipulated, overvalued, was never worth any of these prices, any of these market caps in 2001, 2, 3, 4, 5, well, okay, then explain to me why GameStop has been manipulated and unfairly valued for literally its entire history. Has it been overvalued forever? Because right now it's valued less than, considerably less than it ever has been. And if you just look at the chart, it's hard to see that, right? You're like, oh, wow, 10 billion, 9 billion. Why should a company be worth 9 billion that used to be worth 4 or 5 billion? Seems to be worth a lot more now. It seems like it's already being priced in. No, no, it's worth 9 billion now on a market cap basis, and they have 9.4 billion in the bank right now. So the enterprise value, if you were to just look at the enterprise value history of GameStop from 2002 to 2005, you would see it continuing to decline at historic lows right now. Despite the fact, again, way more money, way less bankruptcy risk, way more operational earnings, way more net income, way better growth drivers, far more scalable growth drivers, right, that are far more impactful on a top and bottom line basis, right? And yet trading at a fraction of its historical market valuation. Hopefully, this is just one other way to illustrate for you how GameStop's current market value Even again, if you don't factor in Q3, I just backed out my Q3 numbers. Okay, Bears, you can enjoy yourself for 4 more weeks, right? Even if you don't count Q3, you only look at Q2, still GameStop today competitively a far more advantageous position than it ever has been historically. And yet its enterprise value on a dollar basis is lower. And particularly when you look at the PE, right? The multiple valuation that by which you come to that enterprise value, right? Much lower now, much more attractively priced now than it ever has been. Pretty crazy. Pretty crazy. And again, if you do these numbers for other years, you can, right? If you want to say, well, I think 2010 is the better comp. Again, I would just tell you in 2010 there's no growth story. Okay, there is no growth driver in 2010, so that's one reason why it's not the best comp. But even if you do that comp then, again, you're looking at a company, I'll just show you. Even if you take the 3 billion, right? I want to look at 2010 because 2010 looks a little lower, right? Maybe it's only worth that. If you look at the 2010 numbers, you're still looking at a company that has negative cash, right? They've got $450 million in debt and only 280 in the bank. So you've got negative over $100 million in cash. You have no growth story. And then your earnings, okay, decent earnings, right? In between that scale, you've finished scaling those GameStop stores. Now you're taking in some money, right? But you're still paying off a ton of debt. And so your net income ends up at 40, a fourth of what it is right now, right? A fourth of what it is right now. And in just one more quarter, it'll be a fifth of what it is right now. Um, and so again, your valuation for a company that is around 3 billion plus that 150 million in negative cash. So a $3.1 billion company, okay, with net income of 40, you still end up with a company that was more favorably valued on a PE basis and even on an operating PE basis than GameStop is today. Okay, hopefully that's helpful for you guys. If you learn anything, you have any other thoughts, would love to hear it in the comments. I appreciate y'all for the support. Thank you for those who have joined the Halo Sub Club. That's all I got for y'all today. I will see you in the next one.